Right, so welcome to Module 5. Last week, as you'll remember, we looked at property and different ways that you can increase your wealth through property investment. This week, I'm going to change gear a little bit. So far, I've been giving you a whole lot of information, but I haven't really asked anybody to do anything yet. So this module tonight is when you stop observing and you start to take action. So it might get a little bit scary, so seatbelts on. So by now, I hope you've worked out that if you stay on this journey and you'll follow the instructions that you see in this journey, you will get wealthy. Now, you might not get super yacht wealthy, you might not get private jet wealthy, but you'll get wealthy enough to do most of the things that a lot of Kiwis can't do in their retirement. So you'll be financially secure, you'll be able to have a bunch of extras, you'll be able to travel, you'll have a good retirement, and you'll be able to set your children up financially if that's something that you want to do. But there is a caveat. Doing this program won't make you wealthy. Doing this program will show you how to increase your wealth, but it won't make you wealthy. Only you can make yourself wealthy. And so the difference is that I can show you a whole lot of things, but you doing the things is what will make the difference. So in the next 45 minutes or so, I'm going to show you 5 things that you will need to do if you want to be wealthy. And they're not rocket science. You might even feel a little bit underwhelmed at the end because they seem so obvious. But these are things that most people don't do. That's why many people don't have financial security that they could have, because if they'd done these 5 things, they would have the financial security. And also just another brief caveat before I start. These 5 things are not easy things to do. They are obvious, or they might be obvious, but they are not easy. Because if they were easy, everyone would be doing them and everyone would be rich, but that is clearly not the case. So to remind you about what I told you at the beginning of the course, and I'll say it again for these 5 things that I'm going to teach in tonight's module. If you do what I've taught you in the course, and if you do what I teach you in this module, you will build wealth, and it will work 100% of the time. Like, these are just core principles that if you follow the principles that are in this module, you are guaranteed to build wealth 100% of the time. So having a spending plan. So one of the first things is we need to have a budget or a spending plan. And I like to call it a spending plan because that sounds nicer than a budget. But this is about tracking your spending and keeping your budget current. So you can't build a tower without first calculating the cost. And it's the same for all of us with each of our ambitions. We need to have a plan on paper, a written down plan of how we're going to spend our money so that we have a plan to follow. So Kiwis are notorious for spending all of their income. New Zealand has a very low rate of savings, and 60% of New Zealanders have less than $5,000 in cash savings, which is pretty dismal. Now, it's not because they don't want to save, it's because they spend up to the limit of their income, and mostly they don't know where it goes. So the reason they don't know where it goes is because they don't have a budget or a spending plan. They don't track their spending. Now, this is actually surprising because it's easier to track your spending now than it ever has been, because our bank records all our transactions for us. And that's not something that banks have always done. But with modern technology, you only have to log into internet banking and everything's there. So, of course, back in the day, you would get out cash. And unless you kept a ledger or you kept all your receipts, it would be very difficult to track where all your spending went. So now, if you go to a cafe and you buy coffee and cake and you use your EFTPOS or debit card, then the bank will record that for you. So it actually should be easier than ever to track spending, because all that information is only a few clicks away. So this is what I think is a common Kiwi household scenario. You have a couple, they're both on the New Zealand median income of about 55,000 per annum, and so there's a household income of 110. So the couple has a first home mortgage, so money is a bit tight, but they can get by. The income's 110, and the outgoings, including tax, is also 110, so they break even. So then one partner gets a new job and the salary goes up to 75,000. So now the household income becomes 130 before tax. Now, of course, suddenly the outgoings, including tax, are also 130,000. And then the other partner gets a promotion and a 15k salary bump, and their household income then now goes up to 145,000. And then, of course, you guessed it, the household outgoings also go up to 145,000, and so it goes on. So they were getting on nicely at 110. Now 120 would have made their life easier, but even at 120, that still leaves 25,000 unaccounted for. It's disappeared and they don't know where it is. We know this is happening because in the last 10 years, wage growth in New Zealand has been almost twice the rate of the growth of the cost of living, which is the consumer price index. So people are earning more in real terms now than what they were in 2010. Yet in 2019, the average New Zealand household still spent $340 more per annum than what their household income was. And on top of that, 48% of Kiwis admit that at least sometimes they spend more than what they earn. So that's very common. Now, the surprising thing is most people cannot tell you where the extra money that they were paid has gone. They can't tell you because they weren't tracking their spending. So the first key to building wealth is to have some funds to start with. And to find those funds, you first need to know where your money is going. The only way you will do that is by having a budget or a spending plan and tracking it. So tip number one for the session is to work out a budget. It doesn't need to be flash. The offset mortgage model is a helpful way to help set this up and manage this. What I'm suggesting for your homework this week is to write a budget or a spending plan. Now, if you're a couple, you can do this together and make that your homework for next week. If you like, you can use the Future Bound annual spending plan, and this is already in the members hub, so you can download that and use that should you want to. Now, a word of warning here. If you're working within a couple, not all couples are good at having conversations about money. It's one of the leading causes of couples fighting. So here's a few things to think about. Do your budget when you are both in a good mental space. If there is some tension, or if you're under stress, or you're feeling a bit fragile or volatile, then it's probably better to wait for a better time. Another one is no recriminations rule. What is done is done. What is spent. Don't get into pointing the finger about what has happened in the past. Our past does not equal our future. It's going forward that we're more worried about. Next one is don't be unreasonable. If your budget is too tight, you're going to give up. So be kind to yourself. Give yourself some fun money in there and make sure that you've got enough money to have a good lifestyle. Lastly, don't budget to spend all that you earn. Okay, don't start with your income and set out to spend it all. Start with your fixed outgoings and see what kind of surplus you can create. Now, if you genuinely have a deficit in your budget, then obviously that you need to do something about that. You either need to increase your income or reduce your spending. I'll talk more about that soon. But my experience is that most clients who do a budget can come up with a surplus. They just didn't know that they had a surplus because they've never done a written budget. Track your spending. Tip number 2 is to track your budget. That's not so hard if you do it regularly. Pick a time of the week where you're free, or if you're a couple when you're both free, not too tired, not too exhausted, too stressed, and make that your regular budget check time. Make it a budget date night if you like. It's very romantic. It'll take about 15 minutes, and if you set a reoccurring alarm on both your phones, you'll remember to do that at the same time each week. So that's number 1, is to have a budget and to track it. And if that's completely new to people and you don't have a track record or a past history of doing budgeting, then there's 2 online tools that you could use to help you. One is PocketSmith that I had mentioned previously. So you can get a free version of PocketSmith, or for I think it's $10 a month, it will do automated bank feeds or bank statement feeds, and you can categorize your transactions to check that you are sticking to your spending plan. And the other one is Booster. Booster, who's the KiwiSaver provider, has something called My Budget Pal. and that's free, and there's no charge for the bank feed feature. So so you can go looking for My Budget Pal online from Booster, and that's a free version which allows you to still do the automated bank statement feed and to track your spending, which is really nice of them to provide that. Right, stay out of debt. So this section is going to be a little bit countercultural. So this is number 2. And so if you've ever wanted to be a radical and a cultural subversive, then this is your chance. And this is about weaning ourselves off consumer debt. So your income is your most important asset. So why would you give it away? If you can keep 100% of your income, your ability to move forward increases significantly, yet the majority of Kiwis choose to give away a chunk of their income through paying interest on consumer debt. So there was a time back in the day when people avoided debt. Debt was like the absolute last resort. And in ancient societies, debt was like the last bus stop before slavery. So back then, the lender pretty much owned the debtor until the debt was paid. And if the debtor couldn't pay, then the lender owned the debtor for life, as in like a slave. So debt, traditionally and historically, was only for the desperate. Okay. Fortunately, those days are mostly behind us, but society's attitude to debt has changed. So currently, which is good and I think probably mostly bad, there is no longer any stigma attached to debt. So why don't we maybe pretend that there is stigma attached to debt, and maybe the new status symbol of the decade could be being debt-free. So debt has really become part of the economic model of New Zealand and all of the Western world. So we started off back in the day with pawn shops and bank overdrafts and short-term loans, hire purchase, payday lenders, credit cards, and then the latest iteration is Afterpay or Part Pay or OxyPay. And so consumer debt has become completely normalised, and a significant part of New Zealand purchases involve some sort of consumer debt, even if it's just putting it on the credit card. So if you don't use debt to finance your purchases, you're actually undermining the New Zealand economic model because you're a radical in a really good way. So someone I know that doesn't buy cars very often was recently negotiating to buy a car from a dealer. And 10 years ago, if you were a cash buyer, that would have been a pretty good bargaining chip. And it still can be sometimes at certain dealerships these days. But back 10 years ago, being a cash buyer for a car was gave you a bit more power. And when this person told the salesperson, though, that they were going to be paying cash, the salesperson replied in mock horror, that's even worse. And because this dealership was quite a big dealership and it ran its own consumer finance arm, and when you didn't use their consumer finance, you were eating into their revenue. So they didn't want you to pay cash. They want you to put it on tick, and that's how they make a significant amount of their income. So consumer credit products are not provided for the benefit of the customer, although they do pitch it that way. The products may benefit the retailer if it means that the people make purchases that they otherwise wouldn't make, but that still costs the retailer, who has to pay a fee and then a commission, of course, to the parent company, the actual lender. So the real benefactor is the lender, and this is the company that runs the scheme. An example of that is Afterpay, which is an Australian company. Their share price has gone up nearly 1,000% between 2016 and 2019. So they are really making a killing. But for households, debt spending is not usually clever spending. It's only clever spending if the value of what you have bought increases faster than the cost to you of borrowing the money. And for most of us, that really is only real estate. Now, so there's times that you might be able to make that with shares, or make that work with shares, but that's pretty high risk. And for people that are in the market for artwork or really rare items, sometimes they can in those specialized games make money that way, but it's pretty difficult. And for most people, real estate is the only type of debt that actually makes sense, because real estate goes up in value. So I don't believe that debt's a good idea, and because when you use debt, you're really giving away a part of yourself, and you're giving away part of your autonomy, and you're losing some control over your life. And on top of that, debt is expensive because debt adds cost to whatever you're buying. And so one way to think of it is to think of interest as rent money. You rent the money off the lender. And why would you rent if you could just buy, right? Because everyone wants to own houses, and we choose to own houses rather than rent. And using consumer finance is basically renting money. So you might say, well, I don't pay interest on my credit card purchases because I pay it off every month. It's just convenient for me. Or you might say it makes economic sense for me to use Afterpay because I'm using someone else's money interest-free while my own money is at work for me. Now, that might be mathematically correct, but what you are teaching yourself is that it's okay to use other people's money to solve your problems. If you plan ahead, you can always solve your own problems with your own money. If you break the habit now, you'll never go back to it, and you'll be 100% better off because of this decision. So everything that you buy with a credit card, you can buy with a debit card. And if you think you're actually winning with those air points, then you're a sucker that bought the marketing message. They're winning, you're not. To my mind, if you weigh the small amount of benefit you gain from using credit cards and Afterpay and the like against the benefit of living by this principle of avoiding debt, I wholeheartedly believe that the principle of avoiding debt wins, and it's a much more beneficial life habit. So I actually encourage everyone to cut up their credit cards, close down facilities, and make the mental shift to only spending your own money. So avoiding debt on consumer purchases 100% of the time if you can, and then you're also going to employ some debt avoidance strategies. Right, so strategy number 1 is to get out of debt. So if you're starting with consumer debt, credit cards or car finance or hire purchase short-term loans, then the first thing is to clear those as quickly as you can. So this is where you're going to use your budget that you're going to create. Your budget will tell you what surplus you have, and you can use that to pay down your debt. One thing though, keep a bit of surplus behind in reserve in case of an emergency, because you don't want to have to use more debt to cover an emergency if something was to come up. Now, once you know how much surplus you have available to pay off loans, there are 2 methods for you to consider: debt avalanche and a debt snowball. So debt avalanche is when you rank your debts from the highest interest rate to the lowest. You then throw as much money as possible at the first debt, not stopping until it's paid off while paying minimum on the other debts. Now, once that is done, the money that was going towards the first debt is directed at the second debt, and so on. This method is mathematically the best. So debt snowball is another method. So when you rank your debts from smallest to biggest, and you pay minimum on all debts except the first one, you throw as much cash as possible at the first one, and once you pay it off, you then redirect to your surplus cash to the next debt, and so on. This method is psychologically better as you get small wins earlier, and this is encouraging, and more people will win using this method. So these are so there are different methods, of course, and you can make lump sum payments along the way, and you check for break fees and whether there's any penalties and things like that. But I've seen probably the best results out of people using the debt snowball, and I'm going to put a copy of these different strategies in the members portal that you can help yourself to after this session. Now, if you have savings that you can access, then you can use those to pay off debt. It's highly unlikely that your savings will be earning you more than what the debt is costing you, so it makes sense to pay your debts with your savings as long as you're disciplined and replenish your savings afterwards, and remember to leave a reserve for emergencies. So another quite common way of dealing with debt is to consolidate it, and you hear this advertised all the time, and this means using debt to pay down other debt. which is not ideal because ultimately you are still using debt to solve your problems again. So mathematically it works because you're getting yourself on a lower interest rate, but most people that use this method haven't weaned themselves off debt and then often have numerous loans again within a couple of years. So if you're going to do this, then treat it as completely as a one-off. Because a lot of people, once they've cleared that debt, they get in that habit of using their credit cards again or borrowing money, and then they're back at the bank 2 or 3 years later looking for another debt consolidation loan. Trust me, I've seen this enough times now, and I've got to the point that I no longer really like doing debt consolidation loans and try and avoid them if I can. Now, of course, you guys aren't going to do that because everyone here is on a different journey and we're going to get much better results. So when paying off debt, the mindset to have is that you are running for your life, because maybe you are. Like, give it intense focus, like a rabbit being chased like a dog. And there's nothing more focused than an animal that's running for its life. So I recommend that you sell everything that's not bolted down. Sell your toys, sell your gym gear that you never use, sell that armchair that you never sit in, sell that kayak that you use once a year. Your priority is getting debt free. Fancy toys and holidays are for later. They have to be earned. If you're carrying debt, then you haven't earned the right yet to have all those nice toys. Right, live consumer debt free. So strategy 1 is to get out of debt. Strategy 2 is to stay out of debt. So staying out of debt shouldn't be that difficult. Most people don't spend all their lives going deeper into debt because they would get to the point where lenders will stop lending to them. Most people get into a certain level of debt that they can live with and their lenders can live with, and then they sort of stay at around about that level of debt. So it's not enough to go broke. It's just kind of like a nice level of debt, so to speak, that they can accept and that their creditors can also accept. So it's just that they've got things back to front, really. They're in the habit of buying and then earning instead of earning and then buying. So once you are debt-free, there doesn't have to be a huge change to your lifestyle. Because if you can survive at a constant level of debt, then you can survive equally well at a constant level of no debt. In fact, you'll be better off, of course, because you're not paying any interest. So strategy 2, staying out of debt, just means changing the way you do things. Instead of renting money to fund your purchases, you just use your own money. Now, admittedly, there is a bit of pain getting to that point, but it's one-off pain. And once you go through that pain, and then you have your finances in a more stable footing, and if you're earning the same amount and spending the same amount, but you can stop having to pay rent money, and you can kiss goodbye to the money landlords that you've been paying rent to all these years, and then you can put consumer debt behind you and get on with the journey of building wealth, because it's just so hard to build wealth when you're paying interest on consumer debt. So, does it sound easy? I'm not sure. I think it sounds easy, but let's look at an example. Let's look at buying a car. So, like I said earlier before, car finance is pretty much part of the auto industry's economic model, and there are people who go through most of their life paying a car loan. So they buy a car on 3 to 5 years finance, and then as soon as it's paid off, or sometimes even before it's paid off, they're buying their next car with a new loan. So car payments are always a part of their household goings. Now, all they need to do is this: pay off their existing car loan at the full term or quicker if they can. And then instead of buying another car, keep the first car for another 3 to 5 years and divert the car loan payments into a car savings account. So that means in 3 to 5 years, they'll have enough money in the fund to upgrade their vehicle. Now, sure, the car that they're trading at that time will be worth less because it'll be an older car, but they will also have saved more money because they weren't having to pay any interest. Then they can go back to doing pretty much what they were doing before, which is upgrading their car every 3 to 5 years. So only now, each time they drive off the car lot, they're going to have a nice new car, and they're going to have bigger smiles because the car will be 100% theirs, and there won't be any debt hanging over their heads. So once you get out of debt, it has to be a full commitment to staying out of debt. Right, so debt is just funding someone else's lifestyle. So if you're going to fund a lifestyle, you might as well fund your own. Right, live on less than what you earn. Sounds easy, right? So the things I've shown you so far in this module are not going to increase your wealth. They will put your finances on a stable footing, and if you have been using consumer debt to fund your lifestyle and you stop doing that, you will be better off. Now, if you do nothing else but this, what we've just covered so far in this module so far, and you do nothing else at all, then you'll get great benefit from that, and you'll get your money's worth of this course alone from just doing a budget and getting rid of your debt. But of course, this course is not about budgeting and staying out of debt. This course is about showing you how to increase your wealth, and having a budget and living without consumer debt are things you have to do before you can increase wealth. And so these are foundations. But now we're going to talk about some of the building and some of the positive things that we can do to actively build wealth. Right, so budget for a surplus. So to build wealth, you need money to start with, and that means saving. Simple mathematics, you need to live on less than what you earn. So as I said before, in my experience, most of the people that I work with, they find that when they do their budget, they do have a surplus. Sometimes it's small, sometimes it's quite large. I'm the first to admit that not everyone in New Zealand is in that position. There are a lot of people whose essential spending is more than what their incomes are, so no amount of budgeting is going to give them a surplus and let them save. But because I'm a mortgage advisor and I'm not a budget advisor, I'm mostly dealing with homeowners. My clients generally are not in that position, and my clients are lucky enough that they can nearly always get a surplus or create one. Yeah, but if you do your budget and you find that you're not coming out with a surplus, then obviously you do need to make some changes. If you're spending all your income and you are treading water, you can only tread water for so long. If you're spending more than what you earn, then that means you're sinking. So you need to take control of that because no one else is going to take control of it. You guys have to do it for yourself. And if you are treading water or you're sinking, then you have two options, and that is either spend less or earn more. If there's a third way, I still haven't figured that out yet. Right, spending less. This is the easier of the two. It just is around reducing your spending. There's two ways that you can do this. You can buy less or you can pay less. So have a good look at your budget and see if you are buying things that you can do without. It doesn't need to be a life sentence. You don't need to do it forever, even if it's just for a period of time. So, for example, if you usually have a fairly expensive annual holiday, can you have a less expensive one for a few years, or maybe have one every second year? Can you live with the same phone or the same laptop, the same TV, the same couch for a few years longer? What else, large or small, can you do without? Now, this is not being hard on yourself, especially if you're not earning enough to pay for them. And I know that this sounds tough and a bit mean and a bit countercultural, but you're not actually entitled to those things. We are not entitled to things that we can't afford. All that we're entitled to is basic human rights. But if we can't afford them, that means we're not entitled to them. But even if you are treading water, these are the sorts of choices that you might have to make if you want to stop treading water and start building wealth. Now, if you can do without some of the luxuries for a few years and work hard in that time to increase or improve your financial position, then you might be able to have them again and without having that budget stress around it. The other way to reduce your outgoings is to pay less for what you buy. So a good place to start is your utilities and insurances. So don't just roll over your insurances and utilities, get quotes, shop around, get on the phone at renewal time and ask your providers what they're willing to do for you. For your other outgoings, think about alternatives. Are there less expensive options for the items or services that you are buying? Think of it this way, you're not downgrading your lifestyle, just repositioning yourself for a better future. Earning more. I like this one. Right, so the other way to earn more than what you spend is to increase your income. Increasing your income might sound like a hard nut to crack. Most people are wage and salary earners who feel that they don't have a whole lot of control over that, but there are things that you can do, and I'm going to suggest 4 things. Now, these won't work, of course, for everybody. Some of them might work for you, though. So the first one is to do some homework on your wage or salary to see if you're being paid what you are worth. Ask around, look at some of the salary calculators online, use several calculators and look for consensus between them, because some of the calculators are a bit unrealistic. If you think you're not being paid what you're worth, have a word with your employer. Now, not in like a gun to your head type of way, because employers don't take that too well, and you don't need to tell them why you need more money. That's not their problem and that's not their business. That's yours. Just present your case for why you think you are worth more. Most employers would rather keep a good employee engaged with them than to risk losing them and having to start fresh with someone else. The second way is to look around and see whether the job market is offering something better. So you're responsible for your career, no one else is. No one's going to manage it for you. So don't be scared to test the market from time to time and maybe even consider a whole new career direction. Now, I don't want to suggest that your job is all about money. You'll spend a lot of your life working. So if you want your life to have meaning, then you'll want a job that also has meaning. So there is an ancient wisdom that says that the question you should ask yourself is, what is the best way that I can serve humanity at this point in my life? If you are a professional, then the best way you can serve will be using your professional skills to the best advantage you can. And in most cases, it will follow that the better you use them, the more humanity you will serve and the better your income will be. Now, even if you are a wage and salary earner, think of yourself as being self-employed and know who you are serving. Really important. Once you have identified who you are serving, go out of your way to serve them in the most amazing way that you possibly can. Stand out from the crowd with your amazing service and watch your career and your income grow. So, money is not everything when it comes to choosing a job. Alignment of purpose and values and fit does matter, but money does matter too. The third way is to add value to yourself. Do some study, learn a skill that complements your skills and extends what you already know, and something that will make you more valuable as an employee, that will add leverage either with your current employer or with a prospective employer. And the fourth way is to supplement your income. And I'm not suggesting doing anything illegal here. This is doing nothing to do with illegal substances. If you have young children, of course, you want to think about whether taking on another job is fair on them or fair on your partner. But if your circumstances allow and there's other work that you can do to earn additional income and build more capital, then secondary employment or freelancing might be a way to do that, and it could be the sacrifice that gives you the breakthrough that you're looking for. Right, number 4, save some money. Point 3 leads into point 4. You will need to save money. You will have heard of seed capital, of course, or seed funding. It's called seed for a reason. You won't grow a tree if you don't start with a seed, and you won't grow wealth if you don't start with some money. Right, gathering seeds. Everything we have talked about in this session so far has been leading to you having some money left over at the end of your week or your month or your year. That money is the seed money that you will use to grow your wealth. Now, you don't need to start with a fortune, and here's an example that I think is achievable for most professionals. If you're able to find an extra $100 a week and you use that to pay down on a $500,000 mortgage, you will save $123,000 in interest at current interest rates. So I don't know about you, but I would rather keep $123,000 than give it to the bank. So it is not saving that will build your wealth, but it's leverage. You are learning on this course, of course, how to leverage your money that you have saved. The larger your savings pool is, the more you'll be able to leverage. But don't think that you need a fortune to start with. So, how to save? The first thing to do is to ring fence your surplus. Take it out of your cash account or your income account so that you can't whittle it away. Put it in an allocated account. Add to it, but don't take from it. It's no longer yours. It belongs to your future. Keep your mitts off it. Invest your savings. So the second thing now is to invest it. Now, if you have a mortgage, then the best thing you can do with your surplus is to pay down your mortgage. Now, that might not sound like an investment, but it actually is a very good investment. So paying lump sums off your mortgage builds the ratio of equity to debt that you have in your house, and equity is wealth. And as we saw in Module 3, you'll save far more in interest paying down your mortgage than you will earn leaving your money in like a term deposit, for example, and probably more than what you'll earn if you were to put it in managed funds, certainly with less risk. So your first step to building wealth is to start paying down your mortgage. Once you have sufficient equity in your property, then we can start to look at more significant investments. My specialty area, of course, is in investment properties and using property to build wealth, and that's why I like to recommend people to go in this direction. Property investment is very scalable, and by that I mean that as your equity builds, you can keep reinvesting your equity in more properties up to your comfort level. But there are other investments as well, of course. Managed funds, fixed interest accounts and shares. Some people choose to specialize in one type of investment and become expert at it. That's fine, and these days you can do a lot of investment transactions yourself because there aren't big transaction fees like there used to be. So whatever type of investment you use, the secret is to become expert at it. So some people prefer to spread their risk by having a diverse portfolio, investment property plus other investments, and that's fine as well. It is likely that you will have a less return, but you'll also have less risk. So, of course, none of this will happen unless you begin with some savings and invest these in wealth creation. Number 5, be generous. Now, this might surprise you a little bit. You might think that I'm arguing against myself, but I'm not. I've told you to be prudent with your money, build up your capital, and now I'm suggesting that you give it away. So giving is personal, and I'm not going to tell you how you should give, or it's still a personal decision that everyone has to make for themselves. But I am going to tell you why I think being generous is a good idea, and then I'm going to suggest some ways that you can do it. So firstly, why be generous? So 3 reasons. It's been said for a long time that giving is very good for the soul. Possibly the best known example is in the Bible, where it says that it is more blessed to give than it is to receive. But that is not exclusive to Christianity. Pretty much every major faith system encourages generosity. But it turns out that giving is good for the body as well, because there's an increasing amount of evidence that people who donate have better long-term health outcomes. So giving is good for your body as well. It's just good for you. The second reason is that giving will keep you grounded. So if you follow this course and you stay the journey, you will become wealthy. And you know what society thinks of wealthy people who forget that there's another world where the rest of the world lives in. And there's names for people like that. And what's her name? Marie Antoinette. Let them eat cake. She was one of those. And I don't want you guys to turn into those sort of people. So giving is a way to keep your head in the real world and stay abreast of what's happening with people that are struggling in this world. So the third reason is that giving will help you make a real difference in other people's lives. So real people's lives will become, at the very least, more bearable, and quite possibly they can become really transformed because you were generous. And often that would actually start intergenerational change. So it's not just one person at one time and point in time that your generosity will change. So as well as building wealth, you will be building a social legacy through your generosity. So how do you go about it? Now, if you're already giving generously, and you have that sorted, then I don't mind if you zone out for a couple of minutes. But for those that aren't in the habit of giving, then I think this is quite important. Now, it is tempting to give small one-off donations to anyone that you see, collecting money or knocking on your door, but this is actually not very effective. So usually charities that ask for small gifts are really after your contact details, because there's a transactional cost to that small gift that you gave, and it's usually quite high, and it might actually take up most of your donation. So this is a better approach. Think about what matters to you. Forget about organizations. Just think about what is wrong in the world that you would like to have a hand in righting. It could be climate change, environmental recovery, poverty, family violence. It could be a medical condition like cancer or heart disease, or hearing or the visually impaired. It could be housing. It could be fresh water access, or maybe education. So there is, unfortunately, plenty to choose from, but pick 2 or 3 causes that really matter to you. Then research what organizations are making effective change in these areas that you feel strongly about. So some will be doing advocacy, some research, some remedial work, and some will be doing a mix of these. So all 3 matter. It just comes down to what matters most to you. So don't be too swayed by administration delivery ratios. These can be easily manipulated and are not too good indicators of effectiveness. Do your due diligence, of course, and make sure that you know who is winning, who's not winning, who's making the difference. I covered that one already, didn't I? Right, let's jump. Become a partner. Right, so then when you found a charity that excites you, and you can believe in them, and you can believe in what they stand for, then get in touch with them, go to their website and see what you can do, and become a regular donor. So most will have monthly giving programs, and these are great for charities because the transaction costs are lower, so more of your donation goes towards making a difference, and that gives the charity more income that they can actually use. So become a partner, not just a donor. Get to know them, keep in touch with them, read their material, and stay informed. Email them and encourage them, because people working for charities are often doing the stuff that no one else wants to do. And none of them are getting rich doing it, so show them some love, because you'll really make their day. And you can do this by going to their events, their open days, and then if you get the chance to volunteer, if there's opportunities to volunteer. So that's why I say become a partner, not a donor, because it'll make your life richer as well as theirs. So that's my kind of little bit of a life coach bit for this module. You can take it or leave it, but it's something that I certainly value a lot, and I hope that has got you thinking about how you can make a difference, or help affect some positive change in this world. Right, wrap up time. So module 5 with the 5 main points, and so that was that module. It's been a little bit different from the last 4 modules, and also from the next module. Just to sum up, we're going to have a budget, we're going to pay off debt and stay out of debt, we're going to live on less than what we earn, we're going to save some money, we're going to invest it, and we're going to be generous. All right, so that's a little twist at the end, is that we are going to be generous. So in this module, we reach the point in this course where I'm going to pass a lot of the power over to you guys. So the other modules were about things that you need to know. And this module has been about things that you need to do if you're serious about your journey of creating wealth. So I ended this module encouraging you to be generous, and I put that in there for the reasons that I've talked about already. It's good for the soul, it helps keep you grounded, and you will change people's lives. But there is another reason that I didn't mention earlier, And as I said, if you stay on this journey, you will become wealthy. And it's easy to get dollar signs in your eyes and think about having wealth, or thinking that wealth is the whole story. But if your aim is only to be wealthy, then no amount of wealth will be enough and you will be unsatisfied. If you want to have a full and healthy life, then your wealth needs to be a means to an end, not an end in itself. So for a bit of homework this week, I want you to think not only about the wealth that you want to build, but about the person or the couple that you want to be with the wealth that you will have. So another way of looking at it would be, what do you want your legacy to be? What would you like people to say about you at your funeral, or your children to say about you to their friends? What things do you need to do to become that person? So I'm not suggesting that you question this journey, because this course is unashamedly about showing you how to build wealth. But I wouldn't be doing my job if I left you thinking that when you have wealth, you have made it. Because this world and this life is more than just money. It's also about leaving a legacy and having impact and making a difference. So I'd really encourage you to think deeply about the change that you would like to bring to this world and the legacy that you would like to leave.